Hello, everyone, and welcome. First, let me say that I hope you and your families are staying safe and healthy during this unprecedented time. My name is Mike Bonner, and I'm the head of Canadian business banking at BMO. This afternoon on the line, we have close to 100 clients from Western Canada, as well as a number of our BMO business banking colleagues. And to my point on colleagues on screen, I want to express a special welcome to Doug Porter, BMO's chief economist. You'll hear from Doug momentarily, and another special welcome to Paul Sipe. And Paul is our head of business banking for Western Canada and will be the moderator for this session. Look, I know that we all know that this is a busy time for everyone. There's clearly multiple priorities going on, and I want to thank you for making some time to what we think is a very special and valuable conversation. It's almost been 1 year since COVID-19 was declared a global pandemic, and over the course of the year, our world has changed in unpredictable ways. Lives have been lost, workers have been displaced, big parts of our economy have been grounded to a halt. Each of us has been impacted, and our team of bankers have been working closely with our clients, frankly, often around the clock, to provide some support. Make sure that all of our clients are aware, we're listening, and hopefully they're taking advantage of all available relief where required. Whether it's CEBA or a BCAP or the HASCAP program, these things are coming at us fast and furious, and we want to ensure that you are listened to and you receive the support that you need to keep the doors open. Small businesses are the engine of this Canadian economy, and our success at BMO depends on the ability to get close to our clients. We really do see ourselves as your long-term business partners. We're on this journey with you through good times, of course, but I believe more importantly, through the hard times. While the road to recovery is still being mapped, there's a lot of things to happen. There's a tremendous amount of underlying optimism, and that's what we should talk about for 2021. We have vaccines on the horizon, as well as pent-up demand for services. That, on top of a recovering global economy, gives us a lot of hope as we look forward. Today, our goals are simple. We want to share some insights, and Doug will guide us on a full view of what's happening and how it's impacting our economy and our businesses. We'll then open the floor to your questions. Many of you have already submitted some questions to us in advance, and Paul will help us and guide us through a moderated Q&A session. With that, I'd like to get things going, and I'd like to turn things over to Doug. Thank you for trusting us with your business, and thank you for making today a priority. Doug, over to you.
Okay, thank you very much, Mike, and good afternoon, everyone. Thank you for joining us here today. So what I plan on doing is basically walking through a relatively short slide deck, which I believe is about 15 slides or so, just laying out where we see the economy going over the next year. And then, as Mike indicated, we'll open it up to a question and answer, which is the period I enjoy the most about these events. As Mike indicated, I would characterize our forecast as being relatively optimistic to others, but I think it's realistic as well. And as we walk through these charts, I'll explain better why we believe that is. But I do have to start with the big picture, and of course, the dominant economic story definitely remains the virus and vaccines. So starting on that front, there actually has been some good news over the last month or so. We have seen plenty of indications that the second wave does look to have crested early in January. The chart that's on your screen in front of you looks at the number of new active cases. It's a rolling average. It's roughly comparable among areas. It's almost on a per capita basis, so we can compare the US, Europe, and Canada. And you can see that everywhere the number of new cases has come down pretty mightily in the last month and a half or so. It has flattened out a little bit recently, and certainly there's quite a bit of concern by many public health officials about the possibility for the new variants to lead to another upswing in cases. But of course, the other piece of good news that's out there is the vaccines, which are now beginning to roll out in a much more rapid fashion than what we saw earlier this year. For instance, even in the US, where there've been a lot of complaints and criticisms. The reality is we're now seeing more than 1.5 million Americans getting the shot each and every day. And that now means that there have been more than 20 doses per every 100 people that have been delivered in the US. In Canada, it's definitely been slower. We're roughly a quarter behind the US on that front. But even there, it does look like the pace is going to pick up. And we have heard some encouraging news, whether it's new vaccines, whether it's Merck helping Johnson & Johnson. Just yesterday, President Biden indicated that he now thinks that every adult American will have access to a vaccine by the end of May, and that's actually an earlier timetable than what we were assuming. And of course, here in Canada, the focus or the target has been to get the majority of adults vaccinated by September. If the U.S. Timetable is moved that far forward, it's quite possible that Canada's will ultimately get moved a little bit further forward as well. Now, sticking with President Biden for just a minute, of course, this is the other wild card that's out there. We're still trying to, get a handle on exactly what the new administration means for the outlook. We've had some mixed news here in Canada on that front, but I think the single most important element of the victory by Biden and the Democrats taking both sides of Congress is the implications it has for fiscal policy. In other words, the amount of spending that we're going to see out of the US government over the next year. Within days of Biden becoming president, he proposed this massive $1.9 trillion stimulus package. It's currently working its way through Congress as we speak. It's already been approved by the House. We don't think that the end bill is going to necessarily have each and every part of what Biden proposed, but it now looks like the vast majority of that $1.9 trillion is going to get spent. And just to put it in perspective, that's almost 9% of the US economy. That is an enormous amount of money. And, while, as I said, there have been some, issues from the Canadian side, whether it was blocking Keystone or, some of the talk around Buy American policies, this kind of huge stimulus will give another booster shot to the U.S. economy, and ultimately that will flow through into better Canadian growth as well. Now, from a market standpoint, it's definitely the case that COVID isn't through with us. But realistically, financial markets are through with COVID. They are looking 6 months, 12 months, 18 months down the line. They're looking way beyond the pandemic, and what they see is very strong growth ahead. They are looking forward to a very robust recovery in the next year or so. And it's not just the equity markets. Of course, the equity market has famously completely reversed that very brief 5-month bear market we had last February and March. And it's not just tech stocks, it's not just the U.S. equity market. Global equity markets have hit all-time highs in recent weeks, even with the modest correction we've seen in the last week or so. The TSX and the S&P 500 are both within 1% to 2% of all-time highs. So this is very broad-based. Even a market like Japan, which has struggled for decades, even the Japanese equity market has hit its highest level in more than 30 years in recent weeks. But again, it's not just the equity market. Another market we look very carefully at is the corporate bond market. And what we saw there is after a spasm, during the crisis last March when corporate borrowing costs shot up, they've now come way back down, and now corporations are actually paying less than they were a year ago. Even the spread, the amount they pay above and beyond what governments pay to borrow money, even that spread is below where it was before the pandemic began. And one market that I didn't put on this chart, but that's really impressed me the most, and that I think is really sending the loudest signal that a robust recovery ahead, is the broader commodity market. And oil takes a lot of the spotlight. Arguably, oil was one of the last commodities to fully recoup or regain the losses that it saw during the pandemic. Other economically sensitive commodities like copper and lumber are either at all-time highs or at their highest level in 10 years and are close to all-time highs. So this is a very broad-based message that the market is sending, and that message is that the global economy, is poised for very robust growth in the year ahead. Now, that being said, there's no question that the global economy absolutely went through the ringer last year. That 3.5% decline that we now estimate for 2020, it hit every economy in the world. Every economy in the world went through a recession last year. In most cases, one of the deepest recessions that we've seen in the post-war era. It's true, China actually did manage to see some growth last year, But even for them, a normal year for the Chinese economy is about 6% growth or close to it, and they only had 2% growth. Meanwhile, Canada and the US were sort of in the middle of the pack, and then a variety of European economies and Latin American economies were hit a little bit harder. Well, that was then. Looking forward to 2021, we think the story is just as it was a synchronous downtrend last year. We're looking at broad-based solid gains almost everywhere in the world this year. We think a number of economies are going to post their best growth rate in decades. The global economy as a whole, we think will grow by 5 to 6% and close to 5% in 2022. And just to put these numbers into perspective, a typical year for the global economy, such as there is, if there is such a thing as a typical year anymore, would be close to what we saw in 2019 when global growth was about 3%. That's about normal. Now, if you sort out, 20, 21, and 22, and you take the average of those 3 years, we think we're going to be just a little bit shy of that underlying trend for the global economy. So we still think there's going to be some catch up ahead out in 2023. But the main message, I want to deliver is that we are looking at a relatively robust, big picture global economy over the next year that will largely recoup the damage that we saw in 2020. And it's broadly, that's the very big picture look. When we bring it down to ground level, it's broadly a similar story for the North American economy. It just so happens that we just revised up our Canadian forecast yesterday. This followed the fourth quarter numbers that were just made official for the Canadian economy. They were much better than expected. But maybe more importantly is that there was an initial estimate for the month of January. And keep in mind that January was right in the heart of the second wave. We were still seeing some school closures in parts of the country. We still had a lot of retail outlets closed in Ontario. There were a lot of restrictions in place across the country. And yet, the Canadian economy actually managed to grow a little bit in January. That was much better than anybody expected. The Bank of Canada expected the Canadian economy to fall in the first quarter. It now looks like we're going to get some moderate growth in the first quarter. And so we just think that puts a much rosier glow on the outlook for the full year. On top of that, we recently revised up our US forecast for this year to 6% growth, partly because of that big spending package that's working its way through Congress. And the third reason why we're much more upbeat on the Canadian economy is just the sustained strength that we're seeing in commodity markets right across the board. Not only is that helping the bottom line of a lot of commodity producers, it's actually leading to real economic progress that's really leading to renewed growth. So even while sectors, like retail, were really struggling around the turn of the year, other areas like housing and the manufacturing sector, but especially the resource sector, were doing very, very well and helping keep the economy on track. And as we go through this year and we get more reopening, and later on, after we're hopefully most of us are vaccinated and we get a second big leg of reopening, we think we're looking at upwards of 6% growth this year. And just to put it in perspective, 6% growth would be the best annual growth rate for the Canadian economy since 1974. Now, of course, this does follow the biggest annual decline in the post-war era, but that's a lot better than I think most forecasters were expecting as recently as 3 or 4 months ago for the Canadian economy. For instance, the latest Bank of Canada official forecast, which was made in January, looks for 4% growth this year. We think that's a very conservative estimate, and as I said, we're closer to 6%. We think some of that strength will carry on into 2022. We won't be fully back to normal by the end of this year. I don't believe so. We think there's still going to be a little bit of catch up out in 2022. As you can see, we've got a relatively similar growth pattern for the U.S. in both years. If anything, I think the bias is the U.S. might even do better, even a little bit better than what we forecast for this year, and then we'd expect Canada be playing a bit of catch up in 2022, and we could see some upside surprises for the Canadian economy when we get out 18 months or so. Now, turning to the provincial outlook, just as I said, every single global economy, every economy in the world saw a recession last year. Well, all 10 provinces saw a recession last year, but there were shades of gray among the provinces. Some were definitely hit harder than others. The two factors that would have led to a worse outcome last year were if your province produced oil or if your province had an especially negative experience with the virus, which was more or less the case in Quebec and Ontario. And meanwhile, you can see Alberta and Newfoundland, the two of the bigger oil producers, were hit harder. Meanwhile, economies that didn't rely on oil or had a less negative experience with with the virus, like the Maritimes, like BC, did relatively well and hung in there a little bit better. Now, looking into 2021, it's not exactly the mirror image of 2020, but it's pretty close. So, in other words, the economies that were hit harder last year, we think we'll see more of a rebound this year, and the provinces that had a bit of a better episode or a less negative episode next year, didn't dig as deep a hole, won't climb out quite as quickly this year. And I have to tell you that the one province that we've been steadily upgrading in recent weeks, and no doubt about it, it's because of oil prices, is Alberta. I mean, we already thought Alberta was going to have a fairly decent comeback in the year ahead, but we're getting increasingly more optimistic, more bullish on Alberta. The longer oil prices hang around the $60 level, that's certainly improving the outlook for the provincial economy. You can see we've got Saskatchewan and Manitoba more or less in the middle of the pack, pretty close to the outlook that we see for Canada as a whole. BC, if you were to average out the 2 years, yes, BC does end up at the top of the heap. There's a few reasons for that. One is fundamentally, we've long thought BC has slightly better growth dynamics than most other provinces. It's in better fiscal shape overall. Its underlying industrial structure is relatively positive. It's got relatively good demographic dynamics. And finally, it had a relatively better experience or a less negative experience with the virus than many other provinces did as well. And so that's one of the primary reasons why BC has hung in there generally better than other provinces when you combine the 2 years together. Now, be that as it may, because of the deep downturn that we saw right around the globe, but especially in North America, we also saw a very fearsome deterioration in the job market on both sides of the border. Now, the good news is that after those scary double-digit unemployment rates that we saw in both Canada and the US back in the spring, we have seen the unemployment rates come down a lot, but there's still quite a bit of work to do on this front, especially here in Canada. Just as a reminder, before this all began, Canada's unemployment rate was below 6%. It's the latest month in January was above 9%. We do think it's going to come down fairly rapidly this year as the economy reopens, as we get that close to 6% growth. But even by the end of next year, we don't think the job market will be fully whole. We don't think the unemployment rate will be all the way back down to pre-pandemic levels, even by the end of 2022. And the reason for that is when you think about the sectors that were hardest hit by the pandemic, that were directly affected, things like travel and tourism, like restaurants and bars, like arts and entertainment. Those sectors, they may not be the highest paying, hire a lot of part-time people. They may not be the most productive, but they do employ a lot of people. There were a lot of jobs lost, especially in those areas, and it's going to take time. Even after we have the vaccine in arms, even after, GDP is recovered and spending is recovered, it's going to take time for these sectors to fully repair and heal. And so the job market may be one of the last areas to completely recover. And the importance here for policy, whether we're talking about government fiscal policy or the Bank of Canada's monetary policy, is I believe that they'll both be geared at the job market. The stimulus taps will not be closed entirely until they're fully convinced that the job market has almost made its way back to full health. Now, even with that weakness that we've seen in the job markets, one of the really unusual features of this cycle, and there have been a lot of very unusual features of this cycle over the last year or so. One of the really unusual things is that household incomes not only did not fall like they normally do in a recession, they actually accelerated last year. And we just got the final numbers on 2020 over just yesterday. And what it showed is that personal disposable income, so the amount of money that households take home after taxes, actually rose by almost 10% last year. 10%. That's the strongest annual gain that we've seen in 40 years. Just phenomenal during a recession. There's no mystery what's going on here. It's due to the incredible level of government support that we saw. Wages and salaries actually by the end of the year were almost back to where they were before the pandemic began. but that 10% blast off in personal income was completely due to government support. Now, while that was going on, we also had households constrained in what they could buy. They could not buy a lot of services, of course, or they didn't want to buy a lot of services because they felt unsafe. And so we had this wedge between rapidly rising incomes and constrained spending. What that led to was just a blast off in personal savings. At one point in the spring, households were saving 30 cents of every dollar that they were taking home. Incredible. We've never seen a savings rate like that before. Now it's come down a bit, but even as we speak, the savings rate is still in double-digit territory. And what's happened as a result of this high level of savings over the past year is Canadians have socked away, we calculate, almost $200 billion more than they normally would have saved in the past year. That's an enormous amount of money. Just to put it in perspective, as a share of our economy, it's comparable to the huge fiscal spending package that Biden has proposed. Now, I don't think all that money is ever going to get spent. I think some of it will just, go to permanently repairing household finances to some extent. But it does sit there on the sidelines, acting as a potential unleashed stimulus that really could support the economy in the year ahead. Now, the other very unusual feature, and like I said, there's a lot of them, is what happened to bankruptcies over the last year. Normally, in a recession, bankruptcies, both for households and businesses, burst higher during a downturn as recession bites down and jobs are lost and businesses close. Well, this time we actually saw a decline in consumer and business bankruptcies over the last year. To me, it's especially astonishing that it happened at the consumer level. But again, this simply reflects the incredible degree of government support. It also reflects the fact that interest rates plunged, so it made debt servicing a little bit easier. And as you recall, about a year ago, the banks allowed mortgage deferrals for a number of months for those who needed it. And so all those things did help keep consumer bankruptcies in check. Now, they've started to climb a little bit in recent months, but they're still down 35% from where they were a year ago. Just phenomenal for a downturn. And even business bankruptcies are down. Now, I don't believe business bankruptcies are quite as indicative. I do think a number of small businesses are just hanging on or waiting to see, how things will shake out in the year ahead. And I suspect that insolvencies will rise in 2021. But again, it's a remarkable performance that we did see over the past year. Now, of course, the flip side of this is, well, how did we pay for this? How did this happen? How did households actually see their incomes rise? Well, the flip side of that was we had this just horrendous deterioration in budget deficits. And this is not just a Canadian story. This happened right around the world. But I have to tell you, Canada was right at the front of the pack. We rivaled any other economy in the world in terms of how much our budget deficit went up relative to our economy. The US was close. Britain and Australia and Japan were in the same league as us, but we were right near the front of the pack. And just as a reminder, a year ago, before this all began, Ottawa thought its budget deficit in the current fiscal year, that's going to end at the end of this month, they thought it was going to be about $30 billion. Well, now in the latest estimate, they think it's going to be closer to $400 billion. Now, I think that's a bit of an overestimate, given that the underlying economy turned out to be a bit better than they expected. But the deficit is likely to be bigger than $300 billion. And, no doubt about it, one of the number one questions I've received in the last year is, how much should we be concerned about this? How are we going to pay for this? Our tax is going to have to explode higher to pay for this budget deficit. What I would say is, let's see what happens to the budget deficit as the economy reopens and recovers. The best cure for this budget deficit would be an economic recovery. And anything that's announced that could frustrate that economic recovery, like the threat of tax increases, I think would be wrong-headed at this time. I think the best policy would be to, let the economy recover, let it get back on its own feet until the pandemic's over, and then let's reassess exactly how much permanent damage has been done to fiscal finances before we start talking about serious tax increases. I think the primary way that we're going to pay for this is through a one-time level step up in government debt. The one reassuring item is, even with the big deterioration that we've seen in the past year, the level of government debt versus the economy, so debt to GDP, is actually lower than it was back in the 1990s. And of course, the interest costs on that debt are a fraction of what they were back in the 1990s. That being said, I think it's very important that the budget deficit does start to come down and come down aggressively as the economy does reopen in the months and quarters ahead. Now, it wasn't just government fiscal policy that rushed out the doors to support the economy. Bank of Canada, Federal Reserve also did everything they could in their power within weeks of the pandemic really hitting our economy last March. They effectively threw the kitchen sink at it in the month of March last year. You know, the one thing that central banks really learned from the last crisis is when you know you're in an emergency, like we knew we were in March, it makes no sense to save your ammunition. Basically, you know, hit it with everything you got, and that's what the central banks did. And I think that's a big reason why financial markets were able to stabilize very quickly in March and have had such a formidable recovery in the past year because they've been really supported by aggressive monetary policy. And what we've seen in Canada here is, you know, the Bank of Canada took interest rates down to as low as they thought they could take it. Their overnight rate's been at 0.25% for almost a year now. They also started quantitative easing, a fancy name for buying government bonds, to help keep long-term interest rates low, to help support financial markets, and it's worked like a charm, frankly. And even to this day, the Bank of Canada is still buying $4 billion of government bonds each and every week. That's $200 billion a year. They alone are almost financing Ottawa's budget deficit, not entirely, but a big chunk of it at this point. And that's one of the reasons why borrowing costs remain so low. Now, eventually, this quantitative easing is going to have to go away, but I think they'll be very deliberate in how they phase it out. I think they'll want to make sure that those long-term interest rates don't sprint higher. Now, on the interest rate forecast, in recent weeks, we have seen a lot of upward pressure on longer term bond yields, you know, on government 10-year bond yields. Even the 5-year rate has begun to see a little bit of pressure in the last month or so. I personally believe the markets got a little bit ahead of themselves last week. You know, they're starting to price in a strong economic recovery. They're starting to price in a bit of inflation pressure. I believe they got a bit ahead of themselves, as I said last week. But we do see a grinding upward tilt in these longer term interest rates. And I have to tell you, versus our forecast that you might see there on the right hand side, um, I believe the risks are more to the high side rather than the low side. You know, a year ago, I was getting a lot of questions about the possibility of negative interest rates. No one's talking, or almost no one's talking about negative interest rates anymore. Now, those are the longer term interest rates. The short term interest rates, you know, things like that drive the prime lending rate or variable mortgage rates. Those are really more controlled by the Bank of Canada and the Federal Reserve. And what the Bank of Canada and the Federal Reserve have been incredibly clear in communicating in the last few months is that they're in no rush to start raising those interest rates. They are going to want to make sure, as I said earlier, that the job market has almost fully healed before they'll start raising interest rates. Our view is that they're most likely to start hiking around the middle part of 2023, so more than 2 years from now. If they're going to go earlier than that, I think that would actually be good news because that means that growth has been even better than what we've forecast. It means the economy and the job market have come back even faster than what we have expected. You know, the main message I want to leave you with on this front is policymakers will be very, very patient. They will be very deliberate before taking away stimulus. If they're going to make a mistake, it's that they keep things too easy, too long, and risk a little bit of inflation in the months and years ahead. Which brings me to my the next topic, and that is inflation. And you know, and another question I've been getting a lot is there a risk? You know, given all the stimulus, given you know some of the stories we've heard recently about computer chip shortages, you know, record lumber prices, container ship rates have gone way up. We're hearing about lots of bottlenecks in the manufacturing process at this point. Is there a risk that we could get a real outburst of inflation? And I will tell you, in the next few months, we're going to get some pretty meaty inflation readings, partly because we're going to be comparing ourselves to where we were last spring when prices fell out of bed in the opening months of the pandemic. We're also going to be affected by a lot of these special factors that are hitting right now, and also the backup in oil prices, and you know that its effect on gasoline prices. All these things are going to come together to lead to headline inflation rising from it's about 1% right now in Canada and the US, lower in most of the rest of the industrialized world, but it's going to go from that very calm, quiet period to a bit of a storm. We're going to see headline rates above 3%, possibly testing 4% by the springtime. The Bank of Canada and the Federal Reserve are well aware of this. The markets are mostly well aware of this. They're not going to get too rattled by that. What they'll be watching for, though, does underlying inflation, when we take out food, energy prices, I should say, does it too start to rise? Does it start to lead to higher wages? And Biden's proposal of a $15 minimum wage, which now seems to have been put to the side, that definitely threatened to lead to an outbreak of generally higher wages. We believe it's not going to lead to broad-based inflation. We think that the little burst of inflation this spring we're going to see will fade away, and that by the end of the year and into next year, we'll be closer to 2% again. But I will tell you there's a little bit more upside risk to inflation than I've seen in quite some time, and I don't think that we can readily dismiss that risk at this stage. And it is going to come, into vogue in the markets from time to time in the months ahead. You're going to hear a lot of talk about potential inflation risk. I still believe that when you're doing your planning, when you look out 3 to 5 years, still very reasonable to base your plan on an average inflation rate of 2%. But again, we have to be a little bit more flexible than what we've seen over the last 30 years or so, because as I said, I think there's a little bit more upside risk. We're in a very unusual economic situation overall, and I think we all have to accept that the bounds of possibilities are a little bit wider than what we've seen in recent decades, and that includes on the inflation front. Now, one area where we have seen unquestionably a lot of inflation, and frankly, to me, this is one of the areas where forecasters really got it wrong, and that's in the Canadian housing market. It is just incredible. This is way beyond a V-shaped recovery. This is much more than a V-shaped recovery. If you look at home prices or home sales and even home building, it's now well above where it was before the pandemic began. That chart on the right, I call that my Canadian Football League chart. Um, these are the 9 cities in the CFL, and that's just the change in prices of existing homes over the last 12 months. That chart has actually got a very similar shape to it as it did. The rankings are almost the same as it was a year ago. The difference is every single city has taken a big step to the right. So the cities that were relatively weak, Edmonton and Calgary, and even a little bit Vancouver, are no longer nearly as weak. We've actually had preliminary numbers for February in Calgary, and it showed a very strong gain in sales, and prices are starting to tick up in Calgary, more than 2% in the latest month. Meanwhile, the cities that were already strong, Hamilton, Ottawa, Montreal, are even stronger. Notably, Toronto is actually kind of middle of the pack. It was just reported today that the average transaction price in Toronto in February hit $1 million for the first time ever. So it's not average from that standpoint. But in terms of price gains and sales gains, Toronto is actually pretty normal. What I don't have here is the cities that don't quite make the CFL, some of the smaller cities. Places like Hamilton and London, Ontario, are actually seeing even bigger price increases than Hamilton and Ottawa. Those cities are knocking down prices gains of 25, 30, in London's case, 40% price increases in the past year. So this is very, very broadly based. The interesting thing is policymakers, they're going to start wringing their hands more about this, but realistically, there's not a lot they can do at this point. I don't see the Bank of Canada, even talking about raising interest rates to try to cool this market. Realistically, that's what it would take to seriously cool down the Canadian housing market, would be a meaningful backup in interest rates. And I think that's a little ways down the road. Now, I don't think we're going to continue to get the kind of gains that we've seen in recent months, but it put me at the end of the spectrum in terms of still relatively optimistic or constructive on the Canadian housing market among forecasters. Last couple things I'll touch on. One is the Canadian dollar. Much like other markets, it was walloped during the crisis last year. It fell below 70 cents at its low last year. It has completely repaired. It's actually back above where it was before the pandemic began. The biggest driver here, well, the two big drivers were the comeback in oil prices, also the US dollar itself. The Canadian dollar, it's like a teeter-totter versus the US dollar. When the US dollar is broadly strong, Canada's on the other side of that teeter-totter and generally weak with other currencies. The US dollar, however, has been mostly weak against almost all currencies over the last 10 months or so, and the Canadian dollar has rode that teeter-totter back up in the last 10 months. Interestingly, though, the US dollar has stabilized, generally speaking, against most currencies since the start of this year. And I think the big sag in the US dollar may be over at this point. However, there are still some constructive factors out there for the Canadian dollar. Anytime the global economy is in recovery mode, that's generally positive for the Canadian dollar. If oil prices continue to hang around $60 or so, that's positive for the Canadian dollar. So we remain mildly constructive on the currency. I'm certainly not pound the table on that front. Our official view is that it is likely to average 80 cents or a little bit higher than that over the next year or so. If looking further out, say 5, 10 years out, I think 80 cents is more like a ceiling in terms of what I would look for the Canadian dollar. I am concerned about Canada's long-term competitiveness challenges, and I would see a fair value for the currency longer term as being closer to the 75 to 80 cent range when we look further down the line. Last topic, last item we'll touch on before we get to the Q&A is, just to wrap it up, while we are relatively optimistic on the outlook, the reality is there still is a large share of the economy that still will remain very heavily constrained until the pandemic is fully in the rearview mirror. And when we look at it, whether it's air travel, hotels, arts and entertainment, food services, these sectors combined directly account for almost 4% of the Canadian economy. That's a big chunk of the economy to be operating with severe constraints. So unless and until the vast majority of us are vaccinated, the economy won't be completely back to normal. The job market won't be back to normal. Hopefully, we will be there at some point in 2022. And with that, I'd like to invite Paul now in to join me for a Q&A, and thank you very much.
Great. Thanks very much, Doug. And I really appreciate your insights and commentary for us here in the West on what you're seeing, keeping an eye on, and of course, using proof points in this pandemic journey to help chart what the future may look like. Obviously, the pandemic is very new to all of us, as old as it feels. And so let me start by mentioning that, again, my name is Paul Sipe. I lead our business banking team in Western Canada, joining you this afternoon from Vancouver. And as we do transition over to the Q&A portion of today's forum, I want to add my thanks to Doug and Mike, to our clients for your time today. On behalf of all of our colleagues, we're truly appreciative of your partnership and our respect for our region's entrepreneurs. So Doug, in the last 18 months, we've seen CUSMA negotiations, we've seen dairy tensions, we've of course seen Buy America headlines. A question for you coming out of Castlegar, BC. How do you see the pandemic and the new American administration impacting the Canadian manufacturing sector? And do you see our economies adjusting to take advantage of any protectionism tendencies that might be on the horizon, both with Canada and, of course, with the globe?
Excellent question. And if you think back to the good old days of 2 years ago, one of our biggest concerns was of course the USMCA, our CUSMA, and our trade relationship with the US. And one of the biggest question marks I have over what the Biden administration means for the Canadian economy is exactly, how our trade relationship is going to unfold over the next 4 years, I should say. And of course, historically, the Democrats have actually been more protectionist than their Republican counterparts. Having said that, I do think trade with the U.S. will be more predictable. I think it'll have less drama. I think from a multilateral standpoint, the U.S. will be much more friendly towards the WTO. You can't be less friendly than the Trump administration was. So from that big picture lens, I'm mildly encouraged. Of course, we also do have the USMCA signed, sealed, and delivered. It was one of the last things done just before we all shut down a year ago. It actually did get through officially Parliament, and we were the last ones to enact the legislation. Having said all that, while the tactics will change, I am concerned that the strategy won't, and that generally speaking, the administration will tend to be somewhat protectionist. They will lean Buy American. That's not great news for us. But broadly speaking, I think the manufacturing sector still can benefit from a very robust recovery. And I think the fact that, at least we'll have more certainty in our trade relationship will help. The fact that we'll probably be looking at a very robust US recovery will help. And I think that will probably largely overcome any concerns I might have on the Buy American front. So when I put them all into the blender, I tend to believe that it'll probably end up being a small positive on balance for the manufacturing sector. I think a strong U.S. recovery and some certainty, at least on the trade front, even if it still remains relatively protectionist, is probably a small net win for the manufacturing sector.
Well, let me just stick with this theory or topic of trade and the theme of protectionism. As you well know, our agricultural industry is an important economic engine in Western Canada, for that matter, Canada. And we've seen tension over canola. It's hit home over the last year. We've seen valuations on grain producing farmland in Saskatchewan come up. A question out of Lloydminster, Saskatchewan today regarding valuations. What economic forces and impacts do you see at play for our agricultural clients in the year ahead?
Thank you for that question, and I actually apologize for not bringing up the agricultural sector in the main body of the presentation, because obviously it's critical for Western Canada. Overall, it's relatively mixed on the agricultural side, but I would say it's positive on balance. It's interesting when we look back, and I was going through the we as I mentioned, we got the final numbers for 2020, both by industry and by spending category for the overall economy last year. And it was interesting. I was looking at which industries actually managed to see some growth in what was an incredibly challenging year, and right at the top of the list was the agricultural sector. Actually saw the best growth last year, and frankly, there weren't many sectors that did manage to grow for the full year. I would split it between the crop side and the livestock side. Generally speaking, I think the crop side's got much better prospects. We've seen quite strong pricing, frankly. Now, we think some of that might come off a little bit as depending on growing conditions this year, but we are roughly upbeat very much on the crop side in general. Livestock's a little bit more mixed. Generally, it looked quite dire at a few points last year, and then we saw a nice improvement through the second half of the year. So we're basically back more or less to pre-pandemic levels. I would characterize it as being mildly constructive, but less a little bit more middling and less directly positive than the crop side of the ledger. It's always tough to characterize because there's so many different stories going on here, but that's generally the way I would see it. We'd have a big green arrow on the crop side and a small, slightly upward green arrow on the livestock side.
Great, good insights. Thank you for that, Doug. And another topic that I'm seeing a number of questions on is something you touched on in your presentation, indicating the housing market had, I think you said, snapped back and gone well beyond a V-shaped recovery. And so our guest today, in fact, a particular client out of Kelowna is asking about the link between housing prices and interest rates, exploring the concept you raised earlier around who's actually in the driver's seat here. Is it consumers? Is it policymakers or other factors? And what does the near-term future for residential real estate prices look like in some of the economies you mentioned earlier?
Yeah, and first of all, it's very fair to say that we've got quite a diverse story across the country. I mean, it's almost every market, as I said, has improved from where it was a year ago. But I have to always correct myself, and I'm coming to you live today from Oakville, Ontario. I always have to recall that when you talk about a scorching housing market, that scorch is mostly in Ontario, with a little bit of singeing in places like Montreal, but it's mostly an Ontario story. Other markets aren't seeing the extreme conditions that we're going through right now in Ontario. But having said that, I mean, I've been quite impressed with the kind of numbers that we're seeing in diverse markets like Winnipeg, like Vancouver, and yes, Calgary and Edmonton are starting to look a lot stronger than they did 6, 12, 18 months ago. We're starting to see sales pick up. We're starting to see the market tighten, and of course, not unrelated is the fact that oil prices have come back with a vengeance over the last 12 months. Who's in the driver's seat? Well, if you look back over the last year, the last 5 years, the last 10 years, the last 40 years, the single biggest driver of this phenomenal rise in home prices that we've seen, it is just the flip side of the relentless decline that we've seen in borrowing costs over that period. Since interest rates peaked back in 1981, it's been pretty much a one-way trip down since 1981 with, a few 1 or 2 year interruptions along the way. That's been by far and away the biggest factor that's lifted house prices to these, seemingly unbelievable levels. But it's interesting when you look at housing affordability, you look at the average mortgage payment versus incomes. Housing is actually more affordable now than it was back in the early 80s when interest rates were sky high. Even taking into account the kind of down payment that you've got to put into place, but it's certainly less affordable than it was even a couple years ago. And frankly, policymakers are concerned at the speed at which the market has come back. The Bank of Canada Governor, Mr. Macklem, just the other day was asked directly about whether he's concerned about how hot the housing market is. Whether he's got to do anything on that front. He said he is getting a little bit concerned that there are some signs of overexuberance. He didn't think it's risen to the level that we saw in 2016, 2017. That may be true for Toronto and Vancouver, but it's not true in other cities. In a lot of smaller centers, we're actually seeing more exuberance now than we saw just a few years ago. If we were in normal situation, I think the central bank would be stepping in to try to cool the market at this point. But as I said, to some extent, their hands are tied because the job market is so weak. We've still got we're still a long way overall from economic potential. That there's not a lot that policymakers can realistically do to cool this market. So direct answer to the question, I actually think the buyer's in control here. I don't think policymakers realistically can step in and do a whole lot at this point to cool the market down. I think they're going to start job owning it. Like they're going to start actually trying to actively encourage people not to overextend themselves. But we know how Canadians love to buy their homes, and if I think there's a risk here, I think it's that the market actually does overheat.
Well, and sticking with real estate for a moment, it's just a bit of a pivot for a moment to office and retail space. We have clients looking to make informed choices about their storefronts in urban big city footprints. And we have a client that's reacting to yesterday's BMO Economics publication, wondering if the hollowing out of urban cores is pandemic related and temporary, or a sign of the future. And that question's coming to us out of Winnipeg, but we're trying to get a sense as to what's happening where we're seeing paper up in windows in the urban core and figure out if that's long term.
So, and thank you for referencing our report. My colleague Robert Kavsik actually just put a report last week, which, by the way, anybody has access to any of our publications. You can go on the BMO Economics website. You don't need a password to get in. It was in our Focus Weekly just last Friday. And basically, he did try to address that question, whether, the major urban centers have been the drivers of the Canadian economy or one of the primary drivers for years. And the question is, has that trend ended? And his main conclusion is no. It may take a few years before they're driving the bus again, but we do think that the urban centers will regain a lot of their moxie in the years ahead. Having said that, we came into this in some urban centers like Vancouver, like Toronto, like Montreal, with some of the tightest office markets that we had seen in a generation, and we're just not going back to that anytime soon. I'm always a little reluctant to say anything that's happened in the last year is going to be permanent, but I think there are some trends, some changes that will be permanent. First of all, I think the take up in online shopping by Canadians, some of that will be permanent. I think basically the future was brought into the present on that front by the pandemic. On the office front, I think some companies will permanently reduce their footprint. Now, that doesn't mean that others won't step in to some extent, but it'll take time for that to happen. So it will be a slow repair in the office real estate market, we believe. But ultimately, we do think that the health of downtown cores will return. I heard a great long-term historical parallel a while back that think about the Great Plague, not to use too negative an example, but did that stop the the increased urbanization and the importance of cities? Not at all. And this was a shadow of the Great Plague. And I think ultimately cities will continue to be the focal point. Will people still want to congregate? They'll still want to come to the urban core.
I'll switch on that very point, and here's a topic that I know passions run high, in particular between our BC clients and Alberta clients around pipelines. But you mentioned Calgary specifically in your commentary a number of times, and so wanted to further explore here your thoughts on the role and the trajectory for oil and gas industry as it relates to an economic bounce back for Western Canada. You commented specifically around the price of crude, West Texas, etc. Have we seen the worst? Are we on track? Are the indicators that you're seeing around the real estate market, for example, in Calgary and Edmonton, sustainable and an indicator of what we should see moving forward?
So short answer is yes, I think they are sustainable. We've been basing our economic forecast on what I consider to be a relatively conservative outlook for oil. We've been assuming $55 a barrel for WTI. We're actually seriously considering upgrading that a bit, depending on exactly what transpires at this month's OPEC meeting over the next 24 hours or so. Our bias might be to slightly bump that up for this year. We're still relatively comfortable holding to $55 a barrel next year. When you look at the average oil price, WTI oil price, and adjusted for inflation back over the last 40 years, it's been between $55 and $60 a barrel, and we're comfortable calling for something in that range over the next year or so. I think the one thing that could change for the Alberta economy over the next few years is, when we look back over the last 10 years, it's really been driven by a just tremendous growth in production of oil. I'm not going to say we're not going to see any production growth over the next 10 years, but I think the growth will be much more limited over the next 5 to 10 years. However, that's not to say that we can't have relatively solid bottom lines from today's oil prices. I think that companies will be a lot more focused on strengthening the bottom line rather than just going for growth in the years ahead. And frankly, some of that will be driven by pipeline constraints. There was one argument, I'm not necessarily going to make it, but there was one argument that based on projections for Alberta oil production in the years ahead, that at the end of the day we might not have ultimately needed Keystone XL. As long as Trans Mountain does ultimately get done, as long as Line 3 does get done, we may not ultimately have needed Keystone XL. It definitely would have given one more option, and I fully appreciate that it was important to the Alberta economy. But given the kind of production schedules I've seen, it is possible that Alberta still can see reasonable growth, even some production growth, and not necessarily require Keystone XL. It would have made life easier. There's no doubt about it. But I think the oil industry can still quietly do reasonably well, even without it, especially at today's prices.
An important topic. Thank you for that. And there are two other topics that I'd like to explore with you, two themes that are coming up from our clients. And the first one is actually a question coming out of Regina, and I think ties into your fiscal floodgates still open slide from earlier in the hour. How are we going to pay for all of this stimulus? And I think specifically the question here is the bigger risk, various levels of government turning off the taps and having the economy potentially sputter, or having the weight of incremental debt being a legacy for generations to come. What's your position on how we handle this landing?
So first of all, in terms of which way I would skew those risks, I definitely think it's more the latter. If governments are going to make a mistake, it's that they're too generous, and that especially goes for Ottawa. Ottawa has, by the way, shouldered the burden, and appropriately so, I would say, in terms of the pandemic relief. That's where most of the budget deterioration has been. Some of the provinces did see their budget deficits widen out as well, especially Alberta, in fact. but it wasn't nearly to the degree that we saw at Ottawa, and that was appropriate. Ottawa does have lower borrowing costs. They have a better balance sheet. They have a better longer-term fiscal outlook. So they really should have borne the brunt of the costs, and they did so. I'm much more worried about them overdoing it rather than turning off the taps too early. I think that's a very low risk that Ottawa will shut down the taps early. In terms of how we're going to pay for that, pay for this, I did touch on that. The one thing I will say is I cannot rule out tax increases. Even for political reasons. We actually just got the UK budget today, and the UK government announced that they're going to increase corporate tax rates by 6 percentage points in 2023. So that's when they believe the pandemic will be over and the economy will have recovered. So that's a couple of years down the line, but still, that's apparently the first corporate tax increase we've seen in the UK since the 1970s, and they framed it as helping pay for the costs of the pandemic. So if I'm finance minister, I wouldn't do anything with taxes until the pandemic's in the rearview mirror. I would want to see exactly the lay of the land, exactly what the fiscal damage has been from the pandemic. And like I said, the best cure for the deficit is an economic recovery. If we increase taxes here or there, that's not going to make even a dent in bringing the deficit down. The economic recovery is going to be the best cure. So I would hold off. But unfortunately, I'm not finance minister, and there are also political realities here. They are getting pressure from a certain segment of society, to quote, "make the rich pay." I don't think there's a lot of appetite in Ottawa in the Liberal government for tax increases, but I think they're going to take a long look at a few possibilities over the next couple years.
Thank you for that, Doug. And the last topic I'd like for you to quickly touch on for us is right out of the headlines of the paper here today in Vancouver, and a question out of Richmond, BC. Is the 2021 tourism industry another year of domestic tourists only? You spoke to this in the last slide that you presented, but what's your best guess on a return to normal for the tourism industry, and how dependent is the Western Canadian economy on tourism?
And frankly, when the border gets open, it is going to be a guess on my front. This is really not an economic story. This is definitely a health/political story. My best guess is that the Canada-U.S. border won't get opened up until the vast majority of the population is vaccinated. I actually think the U.S. is going to push for it earlier, and who knows? It looks as if they're going to be vaccinated well ahead of Canada, and their numbers might come down in a big way in the months ahead, and they might actually have lower case rates than we do if they're vaccinated well ahead of us. So Ottawa may determine that it's relatively safe if they've got lower numbers than we do. But my best guess is maybe late summer, early fall would be a reasonable time to be looking for the border to open up again. Yes, it's important for the tourism industry. The one thing I'll tell you is we do run a tourism deficit in this country. In other words, we spend a lot more abroad on travel, whether it's the snowbirds or people going to Europe or Asia, than foreign tourists spend in Canada. So the fact that money is bottled up and having to rely on domestic tourism for the economy overall is maybe not such a terrible thing. However, there's no question that certain areas of Western Canada do rely incredibly heavily on foreign tourists, and the domestic tourists cannot make up for that. So it is very important, I would say, for the Western Canadian tourism industry to get those borders opened up again. I'm not confident that that's going to happen this summer, though. I think we're going to have to really early this summer, at least. I think we really should pitch it heavily to Canadians to travel where they can, where it's safe domestically. I think I actually think there should be a full-on campaign, especially within provinces, to get people to travel within their own province and see, or even next door province to really see their neighbors. I actually think that's one area that would be useful for government stimulus to be aimed at, is supporting the domestic tourism industry and getting people out and about and seeing their own province.
Couldn't agree more, Doug. And with that, thank you very much for sharing your insights. For our clients, you've had the benefit of hearing from our Chief Economist, Managing Director, Doug Porter, Thank you all for joining this conversation. We're looking forward to thinking about holding more of these sessions to keep you updated. And colleagues like Doug provide great insights into what's happening, not only in our regional economy, but across Canada and of course the globe as well. Please send us your thoughts. If you found this valuable or what you'd like to see more of from your banker. Many of us have been working away from the office for close to a year and can't wait to spend more time with you in your operations, in your stores, etc. I think having a dialogue like this is important to all of us as we navigate this extraordinary situation, and your feedback is key to helping us respond effectively as your bank. So again, thank you to Doug. Thank you to each of our clients for the great questions to help shape our Q&A session today and for putting Doug to work. Stay healthy, stay safe, and please keep in touch. All the best, and bye for now.